The McIlvaney Weekly Commentary, covering monetary, economic, and geopolitical news events.
February 1966 is when the Dow peaked, both on a nominal basis and on an inflation-adjusted basis. On a nominal basis, it got cut in half. On an inflation-adjusted basis, it dropped from 1966 until 1982. And now you got Musk in 2026 being the first trillionaire. To me, those things, there's a rhyming there. It's not anything specific, but to me, it's the kind of thing, as I would say, is really going to look good when you put a couple of arrows on the chart. And if 2026 ends up being a high and SpaceX ends up being a peak, this doesn't end well. We all know that. But what we don't know is when does it end.
Now here are Kevin Orrick and David McIlvaney.
Welcome to the McIlvaney Weekly Commentary. I'm Kevin Orrick along with David McIlvaney. Dave, we've got a guest today, another Dave. Tell us about him.
Dave Allman has been in the world of technical analysis for 50 years and has had the opportunity since 1983 to be working with Bob Prechter through the early 2000s, late 90s and early 2000s. He conducted a series of interviews which have been put into a book called Wall Street Uncut, Unconventional Interviews with Giants of Technical Analysis. I love it, Kevin. I think it is a great introduction to the various methodologies, the things that have worked for various traders through time. And there's many of these aspects that weave their way into the way that we manage money. Indicators and thresholds and rules for risk mitigation that are absolutely imperative. And so look forward to the conversation with Dave.
I'm also looking forward to hearing what books he reads. I know he is a voracious reader.
Dave Allman, you've worked closely with Robert Prechter since 1983. And reading your recent book, Wall Street Uncut, Unconventional Interviews with Giants of Technical Analysis, I thought I was reading in Norton's literature anthology of technical analysis. It's fabulous. Where do we start? Your book is not the anthology like 1,000 pages plus. It comes in a more modest 250 pages, but the breadth is still staggering. I went to the table of contents, and to be honest, my first question was, where's Bob Prechter? Where's Louise Yamada? Where's Alan Shaw? And of course, I did find Shaw eventually buried in Chapter 12. I was grateful. These are interviews conducted 25 years ago. And so our listeners might ask, are they still relevant after all that time? And I would say, well, is the truth still relevant after 25 years, after 250 years, or 2,500 years? I think the answer is yes. So thank you for opening so many varied lines to the truth and lining out facts of the marketplace. Welcome.
Thanks, David, and thank you for that very kind and generous introduction. I appreciate it. And thank you. I still have a copy of my Norton's anthology from when I was in high school, I think, and I didn't finish reading that either. So we decided, we being, Bob and I, kicking it around one day, going, the only time technical analysts get interviewed are on Wall Street Week, and Wall Street Week had an attitude about technical analysts. And we've come a long way since the year 2000, let alone 25 years prior to then. So we just wanted to try something a little bit different where we let the technical analysts shine and talk about their methodologies more than they were getting to do on Wall Street Week. And that was the inception of the show, and it just went from there.
You know, what I loved about the book is you've got 16 interviews with technical analysts that share a love for measurement, calculation, deep regard for price action, and all of them share in common charts capturing history, reflecting bias, revealing belief, showing psychology, and maybe even at times in the market psychosis. I'd love to start with your story. From the 80s till now, you've operated as something of a charts linguist. You're studying the universal language of investor choice, and we see it in lines, we see it in the technical indicators. Where did that start for you?
Well, I grew up on the boardwalk in Atlantic City, and in 1974, the gambling referendum in Atlantic City failed, and in 1976 it passed, and in May of 78 they opened the first casino in the hotel a half a block away from where I'd spent all my formative summers from when I was 11 years old, right across from Steeplechase Pier. And I got hooked on the gambling stocks. The gambling stocks back then were a less roided up version of Bitcoin or AI nowadays. You used to say they were a less roided up version of biotechs back in the late 90s or dot-coms in the 90s, but now you got to talk AI and cryptos. And essentially that you could throw a dart at anything that had anything at all to do with gambling stocks, and the stocks were just going up, just up, up, up. And it was a few months until I learned that stocks actually could go down. And that was an interesting lesson, being on margin and finding out that, wait a second, you just lost a lot of money.
Markets can move both directions.
Yeah, but I was absolutely hooked, and that's what led me to get involved in technical analysis. Essentially, Joe Granville, who was hot as a pistol back then, was touring, and he was primarily in the Northeast, and that's Philly and Jersey and et cetera. And Granville was not only a major proponent of technical analysis, he was also an incredibly entertaining, iconoclastic presence, and he was touring. So everything about him drew me into the business.
We've got a number of interns this summer who are learning about equity analysis, and there's fundamental analysis, which we're starting them with, just so that they understand the difference between a balance sheet and an income statement and various metrics, whether it's price-earnings ratios or price to book. But the keystone for the summer will be a big book on technical analysis, and for them to bring that synthesis. What was your gravitational pull towards technical analysis as opposed to fundamental analysis?
Well, fundamental analysis didn't work, and there were any number of things that you would see. The basic one is a stock comes out with good earnings, good guidance, good everything, and it goes down. Or vice versa. Stock comes out with bad news, bad this, bad that, and it goes up. There was no rhyme or reason to how that didn't work. And there are many, many other examples that we can look at throughout history. I mean, look at how the Federal Reserve Board, for example, who are supposed to be guys who get paid for their opinions and paid to know what to do, and yet completely missed inflation, completely missed the rise in interest rates, were theoretically in charge as interest rates skyrocketed to close to 20% back in 1980, 1981. So it wasn't that difficult to go, gee, fundamental analysis probably really doesn't get it. What else is there? Oh, let's check out technical analysis. The first book that I ever read, and what really got my attention, because I'm a math guy, was How Charts Can Help You in the Stock Market, the book by Bill Giler, Jiler. It's just a very, very basic, I don't want to say watered down or dumbed down version of Edwards and McGee, but that was what did it for me. It was the first time looking at charts and going, oh my gosh, there's a history here. Look at this. And look, there's not just a history that goes back 3 months or 6 months or, in some cases 10 years or even longer than that. And you can see what happened and how stocks absolutely, wow, this stock really came from nowhere. Or, oh my gosh, look, this stock has dropped 80% 4 other times in its history. You don't get that from fundamental analysis on Wall Street. You don't get that from people who don't look at historical charts and get a sense of what has come before. And if you were asking me, hey, Dave, I got a group of interns who I'm trying to teach about the stock market, man, teach them to look at a chart, teach them to look at history and see what has happened, and not to take what they hear anywhere at face value. Do the research yourself and check it out. I don't want to get too tangential, but one of my pet peeves is when you'll hear some commentator report a number as though it's a big deal number. In fact, a lot of what you see nowadays are numbers that are reported as, this number just set a record, that number just set a record number of this, et cetera, and you go to read the article, that's the headline. You go to read the article and you see that it's a record because their data set only goes back 5 years. I'm like, well, this market's been around for 50 years or 100 years. How can you make that statement? And it's because they are casual and sloppy about it. One thing that you would not say about any of the people that are in the book or any of the people that I interviewed over the years was that they were casual or sloppy, because they absolutely, positively were not. And one of the cool things for me about all these people is how old school things were back then. I used to be the youngest guy in the room. I'm not anymore. But back then, we didn't have computers on everybody's desk. You had to use a payphone if you wanted to dial up your broker and hope that you could get through so that you could get a quote. And a lot of these people did charts by hand. I think that there's something to the idea that you get more of a read, more of a sense of the market back then when these guys were plotting, and in some cases, Justin Mamus, for example, hundreds of charts a day by hand. He knew whether stocks were moving, were feeling heavy, or whether there was something else happening.
Well, you've got the 16 interviews, and with so many methodologies for technical analysis, is there a Rosetta Stone that ties them all together?
Not that I'm aware of. What I've told people over the years, because I've talked to a lot of guys who trade and a lot of guys who are looking for the Holy Grail and this, that, or the other, and for some guys it's percent R, for some guys it's stochastics, for some people it's MACD, other people it's Elliott Wave, or candlesticks, etc. What I've always and ever told anybody, two things. One, if you've got something that works, don't let anybody talk you out of it, no matter how ridiculous it may sound when you try to explain it to someone. If it's working for you, then just continue doing it until it doesn't. And the other thing is, you only need one thing. So if you've figured out how to use a moving average crossover and that works for you, use it. If you figured out that, man, I just like to trade breakouts from triangle patterns, and that works for you and you know how to manage the risk and how to allocate your assets accordingly, then use that. I think it's whatever works for the individual.
You curated a list of technical analysts for this book, and I wonder why these analysts and what do they bring together collectively? Because frankly, being the person who put together the quote-unquote anthology, my guess is that there was some benefit to you of seeing maybe a little cross-pollination or how these systems can in fact work in a complementary way.
I would love to have some eloquent answer to that and say that I based the selection on this, that, or the other. Over the course of about a year and a half, I conducted somewhere between 50 and 60 interviews, and they were people who were interesting, who were important to the field of technical analysis and were active and were interesting and had done something that was unique and worth talking about. And as far as narrowing that list down for the book, I didn't use a specific methodology for saying I need this person. Granville's in there because he's Granville. I mean, he's the guy. He was, of all the technical analysts on the planet ever, I think, he's the one who had the biggest presence, the biggest personality for certain. And his contributions are significant. But everybody else in the book is in there and has, I think anybody could glean at least one important lesson, insight, value from any one of the interviews and use it to their benefit. And I think that the history is very cool. A lot of these people contributed things that we take for, when I say we, anybody looking at charts today, anybody using an online trading platform takes for granted. For example, anytime you go to a trading platform, or pretty much even just Schwab's a trading platform, I guess, and not to just name Schwab or Interactive Brokers or anybody else, you have a choice of pulling up a line chart or a bar chart or a candlestick chart. In the old days, if you wanted to plot anything, you had to draw that on a piece of graph paper, and you had to grab the high and the low and the open if you wanted it in the close and put your own hash marks on the chart, let alone doing candlestick charts. Now all of that's programmed, so somebody like Steve Neeson, who pretty much was responsible for popularizing candlesticks in the United States, should be credited for having done that. People take the 200-day moving average like it's some magical indicator. That was Granville. Stage analysis is Stan Weinstein. Ned Davis took a weekly hotline and turned it into a major institutional research firm. And then I guess there's some people in here who I'd consider a little bit more esoteric, someone like Evelyn Browning, whose dad, Ivan Browning, took him up there absolutely going to see, he forecast a volcano that didn't destroy the world, and that's what people like to talk about, of course. We see that happen in a lot of different areas. But Browning made some very, very insightful comments about long-term climate cycles and climate change and things like that put everything that is on the top of people's minds today about global warming in a much better perspective. People forget that back in 1975, the big worry was global cooling. They were worried about the next mini ice age. And again, look at the chart. Somebody like Browning or his daughter who continues his work look at charts going back centuries and demonstrate climate cycles so that you can see, oh, this has happened before. Oh, this isn't that strange. Oh, it's not that this was happening 1,000 years ago, and gee, we weren't flying airplanes and theoretically destroying the ozone layer then. So maybe it's not us.
Yeah, there's a common theme throughout your interviews that I picked up on, which is to be a successful trader. And of course, they're using technical analysis to trade and make money. But the common theme seems to be, or themes, risk management and adaptability. Why are those important for investors? How does technical analysis support them?
I think that technical analysis, there's a book by a fellow named Dave Aronson called Evidence-Based Technical Analysis. And I've commented over the years that I wish that somebody had insisted that I read that book before I got involved in the career of looking at charts and technical analysis and being involved in the market. Because basically, it's so easy for people to look at a chart of, let's just say, a moving average crossover. Okay, everybody's familiar enough with that. And go, oh, I'd have bought them when the fast-moving average crossed over the slow-moving average here, and I'd have sold them where the fast-moving average crossed over the slow-moving average here, or maybe down through zero, or what have you. And gee, I'd have caught this move, and I'd have caught that move, and I'd have done this, and I'd have made a lot of money. No, you wouldn't have. And the reason you wouldn't have is because the mind seems to have a tendency to overlook all those areas where the decision that you would have had to make half a dozen times in real time as that same moving average crossed up and then down and then back up and then back down again before it finally crossed up and the move finally occurred. And you weren't there for it because you were burnt out and your discipline had withered a little bit. So, and I know the question is about risk. And I think that even with any form of technical analysis, there has to be an additional layer of how am I going to risk the funds that I have to put at risk? How am I going to allocate? How am I going to place a wager? How am I going to determine how much money I can lose? And I think there are numerous ways to do that incorrectly, and there are numerous ways to do it correctly. I don't know what the holy grail to that is, but it's something that, again, people should not summarily or casually ignore. It's something that has to be dealt with. And as you point out, a number of the guys in here, Stan Weinstein, Justin Mamus, I think specifically Earl Hannity, all talk about risk, but I don't think that any one of them has, hey, here's a golden formula that's going to guarantee that you make money.
Yeah, it seems like there's kind of a rules-based system when it comes to technical analysis, and those rules could be as simple as cutting losses and letting profits run. Those risk mitigators could be back to position limits and what you're describing about, how do you allocate funds, what's too much, what's too little. The unique thing seems to be lack of ego. And when I think of the adaptability piece, if the market moves against you, if price action is not supportive, you break a particular trend line or what have you, what's the next thing that you do? You don't convince yourself that you're right. You don't even try to justify the position that you've taken. You go ahead and reverse course. And that adaptability seems to fly in the face of a lot of the ways that investors approach the markets, where they get enthusiastic about something. They buy into an idea or a narrative, or going back to our earlier conversation about fundamentals, you develop this case that this is the greatest stock ever to own, only to discover you're losing money, but you remain unconvinced that you're wrong. Can't be wrong. There's perhaps a little bit of ego involved. So I love the adaptability built in.
Right. And if you're not humble, the market has a way of providing that humility, I've found, over the years.
Oh, yeah.
Right? Right. So,
oh, yeah.
Again, I don't know if there's a methodology out there. For example, what methodology out there told you that you should buy Micron a year ago, or let alone back anywhere coming off the lows in 2009? I mean, this stock was $2 on a split-adjusted basis. It's over $1,000 today. What combination tells you you need to be buying this $2 stock as opposed to another $2 stock? And so for me, after being in the markets for, I'm pushing 50 years, that's still a question. It's largely a matter of individual makeup. Take Bitcoin, for example. Forget buying if you bought it at 10 cents or when it was pop. Here's a question. So in the year 2010, Bitcoin's coming out. It's a new currency. It's trading at 10 cents, right? And at that point, I had a couple of dollars to rub together. Is that the expression? Not like in 1980 when I had my brief failed stint as a stockbroker because I wanted to be near the stock market. And this is great. They'll pay me and I can be near the stock market and sit and watch quotes all day. But I quickly learned that sales wasn't my forte. It was more technical analysis. And interest rates were at 20%. It'd be great to lock some of that in, but didn't have any money. Why didn't I put $100 or $1,000 in Bitcoin in the year 2010 and leave it there? But even if you had, and had my share of okay, I bought this stock, I bought it at $1, maybe I put a few dollars into it, but there's no way that if I had a position in a stock like Micron at near the lows in 2010 at $2, then I'd still own anywhere close to that position here in 2026 with the stock at $1,000. It's just not happening. So what, in terms of asset allocation or money management or just discipline, sorry about that, tells you or allows you to stay in that stock? I don't think that there will ever be an algorithm that does that for people. I don't think that's possible.
Yeah, I think it was Ralph Akimpora who basically said, Prudential hired me to get in early and to get out early. And it didn't have to be perfect.
Right.
You didn't have to be there for the entire move, but you were looking for signals to do something, to take action, and that could either be growth-oriented or risk mitigation-oriented. Many of the interviewees that you have in the book, I either know personally or have met at conferences or have read or read about over the past 25 years. And there's no bibliography at the back of the book, but there is reference made to dozens of books throughout. And I wondered if you would pick top 3, top 5 that have influenced your thinking and trading practice sort of within this genre of technical analysts.
Personally, now, like I said, Giler's not in the book because he wasn't around to interview, but people could find a copy. I would read that. Granville's New Key to Stock Market Profits was 1960, plus or minus a couple of years, and I think people should read that just to see what the state of technical analysis was way back then. And again, I realize I should be promoting the book, but I would encourage people to read Dave Aronson's book, Evidence-Based Technical Analysis. I think that's important that they read that. Stan Weinstein's book is a great overview and a great presentation of technical analysis and on a practical basis. And then I guess the other book that influenced me significantly was not written by Evelyn Browning, but by her dad, Ivan Browning, Past and Future History. I think that's an important book as well because it deals with climate and it deals with the influences that climate can have on economies and on people. And I think also because it underscores that there's data and charts going back thousands of years in some cases. And to ignore that data is to be out there playing a game without all the tools available to you to do your best job. And I think that's true as far as markets are concerned, too.
Well, to illustrate that point, you mentioned Micron, and, so it goes from a $100 billion market cap last year to $1 trillion this year. Significant move. Does it go to $4 trillion? Well, one thing we do know is that semiconductors run in pretty radical cycles. We've had 14 cycles since the 1960s, and they tend to be very boomy and very busty. They go up like a rocket, and then when the rocket runs out of steam, they roll over hard. If you were looking at a one-year chart, you don't have enough data. You don't understand that this is a whole sector that gets sucked up into a fervor and tends to overproduce and then deals with inventory gluts. And you don't see inventory gluts in the charts, but that's what's behind the scenes. You just can't sustain it. And the interest and activity in the stock wanes, price suffers, and you start the cycle all over again. But you go back 50, 60 years, and 14 cycles for semiconductors.
Right. And sure, you can look at the chart and you can go, oh, well, it's a parabolic rise, and parabolic rises always end poorly. But something could be parabolic at 200, and then you change the scale, and gee, it looks even more wow, it's really parabolic here at 500, and now look at the 1,000. Now that's a parabola. You still don't know if it's over or not. And in the meantime, you've got a couple of margin calls between $200 and $1,000 if you were short the name, right?
Yep.
Hey, I used to read your dad religiously. And can I just mention one thing about something that has stayed with me all these years?
I'd love to hear it. I had no idea. This is great.
It's positive. So anyhow, your dad's on back in, I want to say it was 1989. I'm pretty sure that was the year. But he wrote a piece. He had his regular newsletter. It was like a beige color, right?
Yep.
The paper that it was printed on, because the business is significantly different than it was 40 years ago. But your dad wrote a piece about Russia and about the Russian deception, et cetera, and it was just really so well done, talking about the history in Russia and their methodology for combat and for world conquest, and they would say one thing and do something else, and they had a long-range game. And, I've read thousands of articles over the years, and it's one of the dozen or so that stayed with me, and I just wanted to mention that. I always enjoyed reading your dad's stuff, and that piece in particular stayed with me.
Well, if you've got kids, be encouraged. The older your kids get, the smarter you become. And as I look back and go through the archives, I kind of shake my head. I'm like, wow, that's my dad. That's amazing. Well, I wanted to thank you for saying that. I appreciate that.
Yeah, it was very cool, very cool.
At a high level, there's a couple out of the 16 that I think have probably made an impression on you. If there's some things that you could glean or distill down for our listeners, for instance, somebody doesn't know Joe Granville. What is the importance to technical analysis? More interesting to me, frankly, is how he shaped your approach to the markets, what impression he left on you. He's an influence. And this whole principle of ad fontes, go back to the fountainhead. I'm interested in Dave Allman's mind. To get into your mind, I need to know what's been in your mind. Where did it come from? Yeah. So share with me Joe Granville, a Stan Weinstein, a Ned Davis, the ones out of the 16 that really shaped your thinking and your approach.
I think Granville, for me at least, was take nothing for granted. If something is obvious, it's obviously wrong. That was Granville's line. And that the market basically took no prisoners. I don't know that Joe would consider himself jaded and cynical. I would absolutely describe myself that way. But Joe didn't cut anybody any slack as far as the market is concerned. He had his song, The Bag Holder Blues, and he had a little sock puppet that he would lecture with, that he was a bank credit manager. And Wall Street and the financial establishment, he was anti-establishment, that the establishment was always late to the game and always, after the big run-up in a stock had occurred, they would say, give me that bag, and they just, ride it all the way back down. So Granville was a big influence, a very big influence.
How about Stan Weinstein?
I knew Stan a little bit better because he and Bob were friendly. They were both the touring lectures circuit, pretty much the same time, and they would run into it. I used to listen to Stan's update. I used to wait for, I'm going to say it was Friday night. If I find out in hindsight that it was Tuesdays, then, oh well. But I used to wait to listen to what Stan had to say about the market on his hotline that he would record once a week. That to paid for service, you got the letter professional tape reader, which he bought from Justin Mamus, and talk about the markets and whether a stock was in stage 1, 2, 3, or 4, and what that meant, and not to stray from that. But Stan also, I'd spoken to him a couple of times, and I had just started going out on the lecture circuit, and this is a while ago. And he said, Dave, be honest, be pithy, have fun. We've spoken, I guess I talked to him sometime in the last few months because of the book. And he's just always been such a great guy. He's just a great guy.
Before we move on to the next one, I'm curious if his stage analysis, stage 1, 2, 3, and 4. Can you apply that to an index as well as a stock?
Oh, yeah, absolutely.
Where would he put the S&P in stage analysis today?
I don't want to put words in Stan's mouth. Yeah, and I don't know. I'll tell you where it's not. It's not in stage 4A or 4B. Absolutely not. Nor is it in stage 1 or even stage 2. So I guess that narrows it down, but each stage has an A and a B. So we'll leave that there, though.
It's a helpful reference point. If it remains inconclusive, that's fine. As you go through your book, there's a lot of these guys that'll reference things like the stock market capitalization to GDP. And Jim Bianco was talking in his chapter about how it reached an all-time high. It was crazy, never seen before at 150%. This was meaningful to him, not necessarily as a market timing tool, but you're in the neighborhood of elevated levels when you're up in this space. Well, that was 150, and that was the year 2000, and now we're 219. And if it was rich then, it's rich now. Combine that with stage 3-ish. So with Weinstein, you begin to build a composite. And I just wonder if that's not a part of the value of reading your book, is to say, there may be one thing that you trade with, one tool that you use, but there's also a benefit to this sort of composite. If you can create a mosaic of indicators, what does that tell you?
Are you asking what does it tell me today now about the market or in general? As I was putting the book together over the course of the last part of 2025 and the first part of this year, and I'm going through the interviews, many of which I hadn't really looked at for a quarter of a century, and went for a walk with Bob, and I said, this is really a great collection. There's not a bad interview in here. Everybody has something to contribute. Everybody has something unique to talk about. And I'll be honest, I don't have this is the perfect mix recipe of things he put together. I think that everything that people talk about, all the different techniques and methodologies and approaches that the interviewees discuss are worthwhile. I think everyone brings something to the table. And I think all the stories are very, very interesting. It was a significantly different time when many of these people were coming up in the industry and in the marketplace.
And yet what we see after 25 years is that truth ages well. Truth ages well. I read it and it was refreshing. I've got lots of marginalia in my copy, and some of it is a conversation about current market dynamics. Some of it is historical in nature, kind of tying points made in theory to things that I've observed in the charts through the years. And that's the reality, is truth ages well. So what you put down 25 years ago, what you structured into this book, it's very informative. So we talked about Joe, we talked about Stan Weinstein, Ned Davis, anybody else make the short list?
I've read Jim Stack's newsletter, Investec Research, and for, close to 40 years. Yeah, maybe a little bit longer, close to 40 years. And Jim manages, I used the word runs, and he corrected me and said manages, Dave, and manages a nice chunk of change these days. And if I were directing someone to a newsletter that I thought was balanced and did a great job looking at history and a great job assessing all the indicators and putting a composite together and is actually doing it in real time, as I say, he's managing money actively, Jim Stack's Investec newsletter would be in my top 3, absolutely. I don't think Jim has a book out himself.
Well, it does make me wonder if Jim's top 3, who are the other 2?
Well, I've worked with Bob since 1983. When I first read Bob's newsletter, I got it from a friend who worked with Bob Newrock at Butcher and Singer up in Philadelphia. Newrock was at Butcher and Singer. I was at Janney back then. And I read Bob's newsletter about the Elliott wave theory. And I said, of all the stuff that I've read, technical analysis, this guy's different. And it was different because it was based more on pattern recognition. And at the time, I'm in my 20s, I'm like, this guy's got to be old, the way he writes. And he wasn't. He's only a few years older than I am. And I've been very, very fortunate to have been able to work with Bob for as long as I've been work with Bob. Back then, I told my friends, they were like, because I'm in the Northeast, and they're like, why are you moving to Georgia? And I said, well, it's kind of like I'm interested in physics, and I'm getting to go work with Einstein. And I still feel that Bob has a passion for the market, and like I say, he's a few years older than I am, that some people never have in any industry. I mean, the guy still looks at 1-minute charts and tick divergences and breadth statistics every day, in and out. Some days it's actually daunting, right? And he's been prolific. So I'm going to put the Elliott Wave theorist in there because I think that people should read that because I think it's a very good perspective.
I read every copy that comes out. And Bob Prechter, it's such a great synthesis, again, of technical analysis, of course, of what he describes as socioeconomics and cultural insights being brought to bear into a market analysis. It ties into a question I have, maybe something a little bit esoteric. Many of your guests made a correlation between the worlds of music and that of markets. And, I was at dinner, this is probably 5 years ago, and my wife's in local theater group. And one of the guys that's in that theater group, he's a retired treasury trader. And so over dinner, we're talking about the treasury markets and we're talking about interest rates. And he starts riffing on his love of Elliott Wave. And I'm like, I'm going to have dinner with Bob Prechter in about 2 months.
Right.
We met up down in New Orleans and had a great dinner. And he's like, wait a minute, Bob Prechter? And he goes into this story about how he made this big pitch, an institutional pitch in London. And he brings in this full mock-up of a model in a super short skirt. And of course, all these very stiff-collared London bankers are wondering, what the heck is he doing with this rather attractive paperboard life-size model? And she's very, not well covered, I guess you could say. And he goes in and he starts talking about the treasury market and he talks about these market indicators. And all this to say, we're sitting there at my friend's house and he's talking about Bob, and I see all these guitars around his living room, and he loves music. So here's a treasury trader who loves music. I know Bob absolutely is a fanatical music connoisseur, musician himself. And there's a couple people in your book as well that there's this connection between the worlds of mathematics, the world of music, and the world of markets. What are your thoughts on that?
I think, is that left brain or right brain? That's left brain, isn't it? Music and math.
Yep.
There's a structure to music and there's a structure to markets. And at the same time, I think Granville, talked about it. He would bring a piano when he would do his lectures. He wouldn't bring one. They would provide one. And Joe would play it and talk about how there was a pattern to the markets, just as there's a pattern, in Bach or in Beethoven. And you can tell if a note is out of place. And maybe that's true in the markets with charts as well. So I see the connection. I don't have much of a bucket list. I have no desire to play golf or to travel, but I'd really like to play piano better than I do. Archie Andrews played piano at one of the major cycles conferences, which is another book people should read, book on cycles from many decades ago.
Yeah, there was the comments from Connie Brown, and she's talking about octaves and the connection between octaves and GAN lines. And again, I think it is this pattern recognition that fits well. And I think for many people, the first thought of technical analysis is it's somehow voodoo. It's not tied to reality. It's actually more tied to reality. Whether you're talking about Fibonacci sequences, octaves, GAN lines, the interconnection, the deeper reality is there.
Technical analysis has come a long way in the last 40 years when it was really the ugly stepchild off in the corner. And that is not the case any longer. And a lot of that credit goes to guys like Ralph Acamporo and Connie Brown. Connie was very active in IFTA, and Ralph was one of the founders of the MTA in getting technical analysis recognized as a discipline pretty much by the New York Stock Exchange, and getting the CMT exam and licensing to be up there with the CFA. So, it's it was Virginia Slims. We've come a long way, baby. Yeah. Connie, unfortunately, was very young, and she passed away last year. She worked with Elliott Wave International for a while, and Connie could be very, very intense. The book talks about she was a world-class swimmer and incredibly disciplined and incredibly focused. And she brought that to the markets too. And you don't want to get in between a trader and their focus. The only advice I would give to somebody. Yeah.
Well, so we talked about the connection, perhaps esoteric connection between music and the markets. Now to sort of a practical application. And this is, as we wrap up our conversation today, your views on markets, drawing from technical insights. You could give a 2-sentence answer, however much you want to go into this. But your insights on U.S. equities, bonds, thinking of treasuries, precious metals, real estate, kind of the big categories of investments. Technical analysis tells you what about those big asset classes today?
I think a traditional read of technical analysis, stocks are incredibly overextended, but you could have made that statement, as you pointed out, a year ago or several years ago. When you get an index like price to sales and you go, wow, it was 1.5 in 1987, and I'm making that number up, and it was 2.5 in 2000, and now it's at 4.6. How high is high?
Well, it would be SpaceX at over 110. with the long-term median being 1.6.
I look at things that strike me, and since you mentioned SpaceX, Bob just wrote this up in the newsletter, but we had talked about it earlier this week. Musk is the first trillionaire, et cetera, et cetera. Everybody knows that. But it got me thinking, because Howard Hughes, right? He was a billionaire, and he had something to do with planes, and he had long fingernails, and went off by himself, right? When was Hughes popular? And I dug it up. I just Googled it a little bit, and Hughes's peak fortune was, guess a year. Guess what year Hughes's peak fortune was?
This might be late. I'm thinking of the popularity of airplanes, 1937.
No, that's too early. Okay, but he was big then. He was still around. To be honest, I was thinking Hughes. Yeah, he must have been 40s and 50s, right? Anyhow, Howard Hughes' peak fortune was in 1966.
Oh, it's classic.
Now, 1966, I'm sure you know, but for the listeners, February 1966 is when the Dow peaked, both on a nominal basis and on an inflation-adjusted basis. On a nominal basis, it got cut in half. On an inflation-adjusted basis, it dropped from 1966 until 1982. And now you got Musk in 2026 being the first trillionaire. To me, those things, there's a rhyming there. It's not anything specific, but to me, it's the kind of thing, as I would say, is really going to look good when you put a couple of arrows on the chart. And if 2026 ends up being a high and SpaceX ends up being a peak, you can't have extreme, this doesn't end well. We all know that. But what we don't know is when does it end?
Right?
And technical analysis is going to give you, whether it's pattern recognition and you're counting to 5 with Elliott wave, or whether you're looking at moving averages and you're using a cross, or whether you're looking at a divergence on a stochastics or an RSI or Williams percent R or whatever, there will be a signal. And that signal might be on the 5-minute basis or the 10-minute basis or a 15 or a 60 or a daily or a weekly, whatever. What you don't know is that the big kahuna? What did I just reel in? Did I reel in, okay, this is just another 2-day top, and they're going to scream to a new high next week, and I better get out of the shorts that I just put on? Or did you catch something bigger? And you're going to, as you say, as you said earlier, cut your losses, let your profits run. How do you know? So, do you trail a stop? Do you use moving averages? What period moving average do you use? Do you try to count to 5 and count to 3 and then count to 5 again? Which one of those is going to work out for you? Sometimes it works out, and sometimes it doesn't. As far as bonds are concerned, I have a personal bias. I would love to see rates go into double digits because I'd like the T-bill interest now that I have a couple of shekels that I could actually collect interest on.
What about real estate? People tend to think of that as a safe place to be. I had that question asked yesterday on a call with about 500 people. They're like, yeah, but what about real estate?
Yeah, real estate's not a safe place to be. Everything cycles. Real estate does the same thing. I have a very difficult time, and because my kids both bought property sometime in the last few years, and after me saying, prices are awfully expensive, it used to be $100 a square foot would buy you a very nice interior to a home. back 30, 40 years ago, maybe even more recently, depending on when. Now, you get barely builder grade, and they're charging $300 a square foot for it, and people are fighting over it. Now, that's changed a little bit over the course of the last couple of years as the market's changed and interest rates are no longer 3% to get a mortgage, and people are just like, I can't afford to pay that. But those things cycle. Real estate's going to come back. It can be a store of wealth, but that depends on whether or not it's a consumable or whether you're looking at it as a speculation. And if you look at any long-term chart of real estate prices and you believe at all in reversion to the mean, you know that one of two things are going to happen. Either real estate is going to sit here and prices are not going to go higher for the next 15 years while that average catches up to them, or real estate prices are going to drop 30 to 50%, which I get it. Gee, how could that possibly happen in order to get back to what's traditional mean level?
Well, there's the mean reversion suggestion, but there's your comments on U.S. Treasuries as well. You see the 10-year march towards 6, 7, 8%, let alone the double digits that you are dreaming and hoping for. If we get them, where do you think real estate is? I mean, this is a levered asset.
I don't think they have to go together. Higher interest rates don't need to take real estate prices higher. I would point to 1981, 1982, when real estate was definitely in the doldrums. I was there, I know, and rates were sitting at 20%.
And that's what I meant. It's like the other end of the seesaw. The higher the rate goes, the lower the home value goes, particularly if there's debt attached to it. So the last one, just to get an idea of where you think metals are today and what their future holds as a technical analyst.
If you took Weinstein's approach, I think the metals are certainly in stage 3 somewhere and haven't quite finished that up where they're ready to launch again. And the plethora of radio ads from a variety of celebrities that came out when gold was 5,000 pushing 5,500 kind of said it's done for a little while. I know the guys who do the Elliott Wave stuff at the office who spend a lot of time with gold are looking at, we did a good job calling it, or we're looking for a correction. And I think for a little bit lower before it gets its feet underneath it again and then heads higher on an intermediate term basis. So I'll defer to them.
Yeah, we've talked to Steve Hochberg.
Right.
And the impression that I got was, short-term correction, intermediate, long-term, it's got legs.
Right.
But they also take it a day at a time, so.
Right, exactly. You got to give credit to the guys, and I think your dad would have been one of them, who were the long-term gold bugs when gold was, after it had peaked at $850 in January of 1980, and it's come down and it's trading, $250, $300, $350 an ounce. And, long-term, the guys are like, this is real money. This is it. This is where you got to be. And, you got to buy gold. A guy who, you have to respect a guy who had not just the vision, but the conviction to say, I believe that gold is real money and that everything else is fiat. And gold is where I'm going to put my money, and who has acquired and accumulated and held on to gold for the last 30 years and owns it at less than a tenth of where it's trading today. You have to respect somebody for being correct and act on that conviction.
It's amazing to have that conversation with my dad. He's got ounces at 35. He's got ounces at 197. He's got ounces at 102 in the context of the correction from 197 to 102 on its way to 400 and then 875. He owns more ounces at 450 off the correction of 875. And he's really not particularly perturbed by the fact that he has ounces at, 850-ish and 450-ish and 102 and 197.
Yeah. That's the whole we're not worthy. You got to look at a guy like that and you go, well done, well played.
Well, Dave, thank you. I'm going to say the same. Well done and well played. I appreciate your book. I appreciate the effort that you put into the interviews a couple decades ago and the effort to put it together into a book format. It's a great primer into the various methodologies in technical analysis. It broadens the scope and I think is going to create a good bit of stir. So I appreciate that. Thank you very much. And thanks for joining us on the commentary.
David, thank you for taking the time and guiding the interview. I appreciate it very much.
Dave, if people are interested in finding more about your work and ordering a copy of the book, Wall Street Uncut, where can they find it?
It's ElliottWave.com, 2 L's, 2 T's in Elliott, /MWC. That will take them directly to a link for the book. I can say with certainty the book is better than I've represented in this interview.
This has been fun. This has been fun. Dave, I look forward to a dinner in Atlanta. Next time I'm through town, I'd love to get together.
Okay, terrific. Thank you, David. Very nice talking to you.
What an interesting interview, and I think it was a shock to you, Dave, that David Allman was also reading your dad probably when you were just a child.
Well, I actually have some recollection of that particular newsletter because it was the look at glasnost and perestroika and the very complicated and well thought out program of opening up and bringing in foreign direct investment into the Soviet Union to sort of refortify and retool for the next stage of progress towards world domination. Now, outside of the Cold War, that might sound a little bit crazy, but that is the world we lived in. That was the letter my dad wrote, and it does put a smile on my face.
You know, he really had so much respect for your dad, too, because here's a technical trader. Prices mean a lot to technicians. Yet, when it came to gold, he just basically said of your dad, well done and well played. For a guy to go all the way back to 1972 and just see what gold is, whether you buy it low or whether you buy it high, it didn't matter. And he appreciated that.
Yeah, no, that's a reminder of what my father's legacy is.
Well, you've been listening to the McIlvaney Weekly Commentary. I'm Kevin Orrick, along with David McIlvaney and our guest today, Dave Allman. You can find us at McIlvaney.com, McAlvany.com, and you can call us at 800-525-9556.
This has been the McIlvaney Weekly Commentary. The views expressed should not be considered to be a solicitation or a recommendation for your investment portfolio. You should consult a professional financial advisor to assess your suitability for risk and investment. Join us again next week for a new edition of the McIlvaney Weekly Commentary.